from all of us here at Robare and Jones, my name is Stan Robare. I'm partner and senior financial advisor for the firm. I wanted to give you all a quick update about the rebalance that's coming up. I'm going to try to keep this as short as possible. The last one I tried to record was about 8 minutes long, so I'm going to try to stop that. But just to sum everything up, we're reducing risk overall across all portfolios. And doing that by a mixture of really three things. The first one is going to be that we're eliminating some of the holdings in our equity portfolio that are typically more volatile in times of corrections. So small cap emerging markets, we're finally getting our final trade of getting out of momentum, which we've held since 2020, March of 2020, but we've been chipping away at that throughout the year of 2021. So this will be our final exit trade out of that position. The other way that we're looking at it is on the bond side of things. We're going to shore up that portfolio as well, eliminating some credit risk. We're going to be adding some cash overall, both from equity and the fixed income side of things. It's going to be about 12% for most conservative portfolios, and then down to about 4% in the most aggressive. And this is really an opportunistic trade. It's not a fearful trade. In fact, we're having to reduce risk on the equity side of things primarily to make room for that cash. It's important to realize cash does not have that negative correlation that those high grade treasuries do against the equity market. So we're having to shore up some of that volatility on the equity side. But we think that is worth it because we've got an opportunity on two sides of the coin here. And that's fairly rare where we have, the opportunity to buy equities on a price at a more favorable price if we have a big equity market event. And on the other side of that, we have the opportunity to buy bonds at a more favorable price if interest rates continue to rise the way that we expect them to. The Fed is probably not going to have much choice but to start raising interest rates to kind of fight this 7-8% inflation year over year that we've been experiencing. On top of that, we're reducing our equity overweight by about 1 to 2%, and I expect that we're probably going to be doing that throughout the year to get us closer to target. Now recall we have been about 4% overweight across all portfolios in the equity side of things because interest rates have been so low. Well, now we're at a point where we've had a little bit of a correction. We've got volatility, we have geopolitical risk, we have supply chain issues, all the things that we've experienced in the last 12 months. Really, none of them have gone away. We've just gotten kind of used to them, if that makes sense. So please let us know if you have any questions. We love to hear from y'all. Feel free to reach out and have a great rest of your day.